Hello and welcome to AI Market News by LM. Today, we are diving into a huge question that's on every investor's mind. Is the US economy headed for a major downturn, maybe even a collapse? The warning signs are definitely flashing, so let's break down what's really going on. So let's just get right into it. Is the US economy really on the brink of a recession? For weeks, this has just been a low buzz in the background, but now, that buzz is getting much, much louder. The fear is becoming real, and it's being driven by things we are all seeing and feeling firsthand. And let's be honest, nothing makes economic anxiety more real than the pain we're all feeling at the pump. This isn't just some abstract chart or a statistic. It's that number we see every single day. As one economist put it, the impact is showing up very clearly, very fast. We can all see it at the nearest gas station. And here is the number that is really grabbing headlines right now. Goldman Sachs has just raised its probability of a US recession in the next year to 30%. Wow, that's a pretty significant jump, and it's a direct result of the surge in oil prices that we're seeing. And it's not just one bank's opinion either. We're seeing this trend all across Wall Street. Major financial firms are cutting their economic forecasts. They're looking at the data and seeing this kind of double threat: higher inflation eating away at our savings and a rising risk of job losses. Okay, so what's causing this sudden wave of pessimism? To really understand the market's fear, we have to look at the root cause, which is unfolding thousands of miles away, but is having a direct impact right here. The ongoing conflict between the US and Iran, that's the primary driver of all this economic uncertainty. It has completely disrupted energy markets, it's rattled supply chains, and it has sent a massive wave of volatility through every single asset class. This quote from a recent market analysis really just says it all. I mean, forget everything else for a second. Right now, the entire global market is basically moving to the rhythm of oil prices. It is the single most important factor influencing everything from stocks to currencies to what the central banks are going to do. This really gets to the heart of why markets are so on edge. There is this huge gap between the official statements and the reality on the ground. The White House projects optimism, talking about peace talks, while Iran continues to publicly reject these offers. This kind of diplomatic stalemate creates massive uncertainty. And if there's one thing investors hate, it's uncertainty. So, from that geopolitical tension, we can trace a direct line to the economic ripple effects that are starting to hit households and the broader economy. And here's where the forecasts start to get a little grim. Economists now see inflation for the year getting closer to 3%, while unemployment is projected to climb toward 4.6%. Now, this is a recipe for something called stagflation. That's where economic growth slows down, but prices keep rising. It's a very, very tough environment for both consumers and for businesses. And this translates directly into real-world costs for all of us. Gas prices have surged over 30% this month alone. That is the biggest jump we've seen since 2005. This is basically like a tax on every consumer, and it's big enough to wipe out any expected benefit from recent tax cuts. So, of course, forecasts for consumer spending are being slashed. So with all of this uncertainty floating around, how are financial assets actually behaving? Let's take a look at the market's live scoreboard and see how investors are positioning themselves for this new, much riskier world. Well, in the stock market, it's been an absolute roller coaster. One day, headlines about a potential ceasefire send the S&P 500 and NASDAQ rallying, but then the next day, a diplomatic rejection sends them tumbling right back down. This back and forth is all over sentiment indicators, which are just swinging wildly between fear and greed, creating massive volatility. And amid all the chaos, we're seeing a classic flight to safety. When global risk is high, investors tend to run to what they see as the safest place to park their cash. Right now, that safe haven is the US dollar, and we can see its value surging as money pours in from all over the world. Now, on the other side of that trade, we have the Japanese yen. As the dollar gets stronger, other major currencies are weakening against it. The yen, in particular, has been hit really hard, falling to levels that are causing real concern for Japan's economy because it makes their import bill, especially for energy, so much more expensive. And looking at the hard numbers here, we can see the dollar-yen pair pushing up toward that critical 160 level, a super clear sign of yen weakness. At the same time, the euro is also losing ground against the dollar. These are the major currency flows that are really defining this risk-off environment right now. So, given this whole complicated picture, what should we be watching for next? Let's turn to some key indicators and events on the horizon that could give us a clue about where the economy and the markets are headed. A really critical tool for this is the CME FedWatch tool.
It's awesome. It essentially reads the tea leaves of the financial markets to tell us what traders are betting the Federal Reserve is going to do next with interest rates. And this is where things get really interesting, a real puzzle. See, normally, high inflation would mean the Fed has to raise interest rates to cool things down. But because the risk of a recession is so high, many are betting the Fed will actually be forced to cut rates later this year to support a weakening economy. It's a huge conflict, and the Fed is in a very, very tough spot. And finally, we absolutely need to keep an eye on the economic calendar. As we can see from the provided information from investing.com, key reports like the weekly jobless claims give us a fresh read on the labor market. Plus, any speeches from key Fed officials could give us crucial clues about how they're thinking about this whole inflation versus recession dilemma. Which, of course, leaves us with the ultimate question. We've got a geopolitical conflict driving an energy crisis, which is pushing up both inflation and recession risks, all while central banks are caught in a bind. In a world this uncertain, predicting the market's next move is truly anyone's guess. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.